Welcome to CPE Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. Today's edition provides a mid-year outlook for the commercial real estate industry as the economy shifts, with topics ranging from the capital markets to emerging opportunities to sector-specific issues. I'm Suzanne Silverman, Editorial Director of Commercial Property Executive, and I'm here today with Mark Zandi, Chief Economist with Moody's Analytics, Rebecca Rocky, Economist and Global Head of Economic Analysis and Forecasting for Cushman & Wakefield, Jody McLean, CEO of Edens, Sarah Queen, Head of Real Estate Equity for MetLife Investment Management, and Mark Gibson, CEO of the Americas for JLL Capital Markets. We are recording this session, and it will be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. And thank you to those of you who submitted some in advance. We'll try to get to as many of them as possible. We'll kick off today's discussion with an economic forecast from Mark, followed by a real estate forecast from Rebecca. Mark, take it away.
Thank you, Suzanne. It's good to be with you. Thanks for the opportunity to be with you in the panel. My task is just to give folks a sense of where I think the economy is headed over the next 12, 18, 24 months. Clearly a lot of concern about recession. Recession risks are uncomfortably high. And I think the consensus is that we will likely experience a mild recession later this year into next. Good reason for that, good reason for concern. If you look at history, whenever the economy is struggling with very high inflation and the Federal Reserve is aggressively raising interest rates to combat that inflation, we more often than not, land in recession. So a reasonable forecast, but I'm going to make the case that we'll be able to navigate through the next 12, 18, 24 months without an economic downturn. I don't want to be Pollyannish. I'm not saying it's going to be easy going. I think it's going to be a difficult economic backdrop, but I do think we have a good chance of making our way through without actually going into recession. Key reason for that is what's shown here in the first slide. I'm only going to show you 3 slides. The first one shows my expectation for inflation. Obviously, this is key to the outlook. Determines how high interest rates have to go to get this back in. This is consumer price inflation, CPI inflation. This is from the beginning of 2019 through the end of 2024. You can see where history ends and forecast begins. Inflation is already moderated quite significantly. CPI inflation peaked at 9% on the nose back last summer. We're down to about 5, a little under 5. You can see, I expect by the end of this year, we'll be closer to 3. And I feel pretty confident in that. That goes to an easing, a further normalization of supply chains, particularly overseas, more vehicle production globally, and lower vehicle prices. That feels like that's already started. And also, I think, again, with a fair amount of confidence that the cost of housing services will moderate here quite substantively. Rent, as most of you know, have gone, multifamily rents, apartment rents have gone flat to down since the end of last year, and that's going to translate through in the form of lower cost of housing services as measured by the CPI over the next 6 to 12 months. And just for context, housing costs account for well over 1/3 of inflation as measured by the CPI. The last mile here is getting the growth in the cost of services ex housing back down, and that goes to a moderating in the cost of labor wages. Wage growth has been quite strong, but I do think the labor market is easing up here. Job growth is slowing. Unemployment is going to start to notch higher a little bit. That'll take the steam out, and we'll be able to get wage growth and overall inflation back down to the Fed's target by this time next year. Obviously, a lot of risk around this. And if I'm wrong and inflation remains more persistent, the Federal Reserve will have to continue to raise interest rates, and we will go into recession. But at this point, I feel pretty confident, and increasingly so, that this picture is going to hold. The Fed will be able to end its rate hikes right here at a 5%, a little over 5% federal funds rate target, and the economy will be able to manage its way through. A lot of risk, though, mostly to the downside. And to help get your mind around that and all the risks is this risk matrix. The x-axis, the horizontal axis, is the severity of the risk. It's kind of like kind of think of it like a present value of economic loss if the risk were to occur. So it accounts for the severity of the risk as well as the timing. So, for example, you can see in the southwest part of the matrix, climate transition risk. This is a threat to the economy, but it's going to play out over a long period of time. Therefore, it's all the way over to the left on the axis. And then the y-axis, the vertical axis, is the probability of the risk. So if you look into the northwest part of the matrix, you see crypto crash. Crypto market, in my mind, has crashed. It's come back again, but it suffered some pretty significant losses. The macroeconomic consequences of that, though, are relatively minor. So you really want to focus on the risks that are in the northeast part of the matrix. And I do want to point out a couple of these. Federal Reserve missteps. Very difficult for the Fed to kind of get this right, raise rates high enough, fast enough to quell inflation, but not too high, too fast that it pushes the economy into recession and break something. Very, very tricky. So easy to make a mistake here. Of course, the banking crisis, the worst of the most acute phase of that crisis feels like it's behind us, but I suspect there will be more banking failures here dead ahead as credit problems start to materialize. I expect them to be small bank failures, but given how on edge depositors are, given online banking and social media, it feels like almost any bank of any size is somewhat systemically important. So fair amount of risk around that. And then you'll see commercial real estate correction, house price crash. In my baseline, I expect price declines in CRE, about 10% peak to trough, a little less in terms of single family house prices. If that's the case, then that's not great. There will be credit problems, but they'll be manageable. The economy won't go into recession. But clearly a lot of things to be concerned about there. Things could go down a darker path, and thus a lot of risk around that. I do want to end, though, by giving you one indicator to watch to gauge whether I'm right or wrong about the direction of the economy. Are we going into a recession or not? At the end of the day, a recession is a loss of faith. Consumers lose faith that they'll be able to hold on to their job, and they stop spending. Businesses lose faith that they'll be able to sell whatever it is that they're producing and start laying off workers, and we get into a kind of a self-reinforcing negative vicious cycle down. A good barometer of that faith among consumers is the Conference Board Survey of Consumer Confidence. That's what I'm showing you here. This is monthly data from the mid-70s. The last data point is for May, just came out. And you can see the recessions, those are the red shaded bars. And prior to recessions, big drops in confidence. That's people losing that faith and running into the bunker and stop spending. And typically, if you see a more than a 20-point drop in this index over a 3-month period, we're going in. Got about a 6-month lead. Fortunately, sentiment pretty close to its long-run average, not too dissimilar, and sentiment is rock solid. May, no change from where it's been over the past 6 to 9, 12 months. So far so good, but something to watch just to determine whether I'm right or wrong. I'll end by saying, Suzanne and Rebecca can attest to this. I'm rarely wrong, but I'm, could be. So watch this indicator.
We believe in you, Mark. We're counting on you. Thank you very much. Rebecca, I will turn things over to you to talk about the real estate market.
Thank you. So I want to start with a slide that just shows the 4 main food groups as we think of them, and make a comment about where they are today before we get into the outlook. I think what should stand out is how different the dark blue line is compared to the other lines. Whether we're looking at industrial, retail, or apartment, the going into the next part of the year and into next year, vacancy rates are at or near all-time lows. Things are shifting, and on the next slide, I want to walk you through kind of the narrative of what's driving the expected vacancy rates that we're calling for. So I'm going to start with retail. Now, these are shopping centers. So most retail are not malls. Most retail includes shopping centers as well as perhaps standalone and other forms of property. This is looking at shopping centers which have essentially very limited to no development, so very little supply side risk. Very resilient demand. We had about 3.5 million square feet of absorption in Q1, despite some of the ongoing announcements of store closures. We think on net this year, we're actually going to see positive absorption and essentially a flat environment next year, with vacancy bouncing around at this very low level of about 5.5 to 6.5%. So in that way, we think shopping centers are poised to perform quite well. Consumers are really eager to get out and go to restaurants, spend on services that you don't necessarily consume online. When you look at both industrial and apartment, I would say both of these sectors can be characterized by a supply wave, as well as demand that's moderated from the 2021 and 2022 levels that were incredibly robust. So I'll start with apartment. In this sector, we actually saw weakness in the second half of last year, which has since picked up on a momentum basis. We are expecting demand to hang out in the kind of high 180,000 or so units this year before going above 200,000 next year. The real challenge for multifamily is that we have a lot of construction, and we think about 480,000 units will deliver this year and over 350,000 next year. So that's what's pushing vacancy up, and we think it will peak around 7%. To some of Mark's comments, rents have flatlined and in some cases trended a little bit down. We think that environment's going to persist, at least in the aggregate, in the near term, but then that will eventually, as vacancy comes down, see some acceleration. On the industrial side, again, a huge supply wave headed at the market. You can think of this sector, which has a quick construction cycle, as a wave followed by a ripple. And we think vacancy will really peak in about 18 months at 5.5%. It might be hard to tell here, but 5.5% is still 150 basis points lower than the lowest vacancy rates we recorded in prior cycles. This is still a vacancy rate that's consistent with fairly decent rent growth. And so for occupiers who are challenged in this marketplace, we don't necessarily see a light at the end of the tunnel and expect rent declines or anything like that to happen. Office remains the most challenged sector, no doubt about it. We have a vacancy rate in our data that's the highest on record, going back even further than what you see here on this chart. And we do think that we still have additional softening to work through. So right now we're at 18.6%. We have supply that is tapering off quickly and little appetite to finance new construction. We are seeing a second retrenchment in absorption that we think will continue through this year and into next before we see vacancy stabilize. Two quick things on the office sector. One would be that there is an intense trifurcation happening. So this is painting with a very broad brush, and there's a lot of nuance. And the second thing would be that this does include our impact of work from home on the demand side that's accounted for in these figures. If we advance to the next slide, I did want to go a little bit into this. I know we'll talk more about it. The wave of maturities is kind of all the rage these days. And I wanted to, just kind of put in perspective some of the estimates that we have around office maturities in particular, as well as bank maturities, given that there are concerns about the bank sector. And certainly when we overlap banks and office, we want to make sure we understand that potential risk profile. I would draw your attention to that bottom line on the table and note that in any given year, banks themselves are facing a pretty limited amount of refinancing or loan maturities in the office sector. So it's not to say there won't be credit issues, that there won't be distress emerging, but I think across 4,500 banks, give or take, these kinds of volumes are quite manageable. And to some of Mark's points, we may see some additional issues that happen in small banks, regional banks, which make up 80% of bank lending. banks are only 40 to 45% of originations in a given year, but we think that those aren't systemic and those should be quite manageable. If we go to the next slide, one of the key challenges right now, although leasing markets are actually in a pretty good place outside of office, it is the capital markets environment. Pricing has clearly shifted in the debt markets, whether it's looking at treasury rates or corporate bond rates, adjacent risk-adjusted asset types that we would tend to look at proxies for. Commercial rates have clearly gone up. This is a challenge. Debt coverage service ratios are going up. LTVs are coming down. Underwriting standards are clearly were tightening before the bank issues and have tightened since. Incrementally. I would point out, though, that most of the tightening happened in the 9 months prior to the bank issues, and on the margin, we have seen things tighten up a little bit more since then. If you kind of go to the next slide, I think what's interesting is that there's also a little bit of a pullback in loan demand. So it's not just supply of credit, it is also the demand for credit that's out there. You may be aware that the transaction markets have been very subdued in terms of activity. And I think kind of the main thing here is that uncertainty is really the enemy of transactions, right? Commercial real estate is perfectly viable in higher interest rate environments. Clearly, we are in one. And if the Fed is right in their broadcast, higher for longer, we think about a year from now would be when they would probably start to pivot. That environment will translate into pricing eventually. We're in the early stages of that. The little nugget I want to leave you with is kind of a takeaway from this slide, which is if you were in a balanced commercial real estate portfolio of the 4 main food groups, you can look at how an investment might perform. So if you went back to 2017, Q4 and invested over a 5-year horizon, you would have divested at the end of last year, and you would have made over a 70% return, which would have been better than any other alternative, at least those that we're showing here, certainly would have beaten inflation. If you were to sell at what we think will be the trough for pricing, you would still come out on par with other alternatives. And if you were to see through that, right, if you're not forced into a transaction to realize that price decline, if we can kind of get to the other side to when rates start to come down and therefore cap rate pressure is less, we think that over a 10-year horizon, you would make up for more than the losses that you would have incurred if you were to divest at the trough. So we still think property is a really compelling investment, but we do think the next 12 to 18 months is going to be challenging in the capital market space, not just because of rates, but currently just the uncertainty is really the main enemy of the market at the moment. I will hand it back to you, Suzanne.
All right. Thank you, Rebecca. Now let's turn to the panel for some follow-up discussion. And Mark Gibson, I'd like to start with you and ask you what your view is on the real estate industry, the commercial real estate industry, as we head toward the second half of the year, and what issues you feel we should watch out for.
All right, Suzanne. Well, thank you. It's a privilege to be here, so appreciate the invitation. I will frame the commercial real estate industry in as short a time as I possibly can. It's a much longer subject than we have here. But if you look at it from a macro standpoint, typically in environments where we have a rapidly changing economic environment, people pause. So they pause in transactional volume, they pause in investing, and they try and discern which way the market's going to go. In this case, there is an identifiable enemy that we all have from an economic standpoint, and that is inflation. And the Fed has reacted by rapidly raising rates, fastest pace in U.S. history. And that caused everyone to pause and go, well, geez, why would I invest if I think the cost of capital is going to continue to rise over time? So I need to stop. And where we are today is that has largely been mitigated along the lines of Mark's previous comments. I will tell you the market already thinks we're at 3.5 mark or 3. It's just the Fed data lags, as does yours. And so the large investors are already skating to that eventuality that they will make progress toward that. The question is one of time frame. And now they're fairly certain that the Fed will indeed put us in recession because historically that's what has happened. They wait too long to adjust on the upside, and they wait too long because their data lags on down, and therefore we tend to find these types of situations. So from an investor standpoint, that's their view. That has resulted in a bid-ask transaction. So Rebecca's comment about transactional volumes being muted, they're down 60% in the first quarter compared to where they were last year. We saw that transactional activity begin to rebound, particularly over the last 45 days. And that is due to the consistency that Rebecca was talking about. So most investors view that the 10-year bond, which is really important to commercial real estate, both from a cap rate standpoint and an unlevered and levered return standpoint, there are consistent spreads above those over time. They believe that that'll be range bound between 3 and 3.5% long term, which is where we've been over the last 45 to 60 days. That gave some folks confidence to come in and start investing, believing that inflation will moderate. That is why the short end of the curve has adjusted to fight that inflation. So believing that the short end of the curve will moderate, and they're better advised today to make investments now if they do believe inflation will moderate over time, which would create a more normal yield curve. So that is what was happening. The debt ceiling interrupted it because the 10-year bond went to 3.8. And we have found that when it is in and around this 3.5 position, we start to see these transactional volumes increasing across the board. Again, there's no naivety to anything I've just said. It's just it's trying to get some consistent pattern in underwriting the appropriate risk. A couple of other points is that the supply that is going to be delivering in the next 12 to 24 months is going to be down substantially. We have a very large market share in the space of raising equity for to-be-built product, and it's dramatically down because you can't underwrite rents and cost at where they are today to make sense of it, which is primarily going to affect the multi-housing and the industrial business, which is where we actually need the supply, but it doesn't work. And then I would say that the sellers to date, just to show the lack of naivety and where people are anchoring toward price, has largely been institutions, so 70 to 80%, but the buy side has largely been private because they had a different perspective of negative leverage and a few other items. So in general, if we get some consistency in communication and consistency in economic policy, I think you'll see transactional volume gradually increasing.
Okay, thank you. Sarah, what do you see as the bright spots for the industry?
So thank you so much for having me. And I'm really glad that I get to lead with what are the bright spots as opposed to talking about all the things that are difficult. So thanks, Mark, and Mark and Rebecca for kind of leading with that. On the bright spot, kind of building off what Mark was just talking about and Rebecca's comments on industrial, that is a focus we continue to see, even with increased vacancies. It's still below where it's been on the long term. We've seen, between nearshoring, onshoring, the, continued focus on how do we get things quicker and quicker. It used to be you were happy if you could get something in 4 days, then it was 2 days. Now if you can't get it in the next hour, you're very frustrated by that. So as we continue to see those demand factors come in, we expect to see, more opportunities in the industrial space, and actually still are seeing some interesting construction opportunities, although fewer and farther between than where we were. We're also starting to see some people look for liquidity in their portfolios, either on their portfolios on behalf of clients who might need liquidity, who are starting to market stabilized industrial product. We're starting to see some deals trade below replacement cost, which we have not seen in a very long time. There's not been a lot of those transactions. I think there's still a big bid-ask spread, but we are seeing some bright spots on the industrial space. Build to rent, so single family homes, but focused on build to rent as opposed to scattered, is an area that we've been spending a lot of time looking at. We see a lot of bright spots there. Housing continues to be a big issue. There's still demands on multifamily, but there are a larger and larger segment that wants to live, 4 walls with a backyard, but have trouble buying a home, particularly as the cost of mortgages has gone up for them and pricing is still high. And so build to rent is really a way for them to be able to do that. And then we don't think that the market fully appreciates the benefit that hotels have actually received from hybrid work. If all of a sudden now you can, you don't have to be in the office on a Friday, you can leave on a Thursday, spend an extra night in a hotel. 1 or 2 extra nights in a hotel meaningfully increases occupancy for them. We've also seen, we have a fairly large hotel portfolio, so we see a lot of what's going on in the US. I will say that, we've also seen a substantial increase in revenue coming out of the hotels, although occupancy has still not returned for the most part to where it was in 2019. Average room rates, as I'm sure everybody here can attest to from their travel schedules or trying to plan a vacation, is way up. So you're still seeing increases on the revenue side.
Thanks. Mark, Sandy, if you could talk about industries, i.e. tenants, that are offering the most potential for commercial real estate, that would be helpful.
Sure. Maybe one thing I will say, though, before I get to the positive is, I think it is important to realize that given broader demographic trends, the aging of the baby boom generation out of the workforce and weaker immigration into the country, we are going to see much slower job growth across the board, across all industries, dead ahead. Just to give you a sense of the numbers, in the last decade, average monthly job growth, I just calculated this, was 165K on average, through the pandemic, through thick and thin, 165K. Next 10 years, we'll be lucky if it's 50K, given the demographics. So, and that is the whole shoot and match. That's leisure hospitality, that's retail, that's office using, can kind of do the arithmetic. That does suggest that demand for office space broadly is going to be much weaker going forward than historically has been the case, even abstracting from remote work dynamics. That's something that was going to happen before the pandemic and before remote work. Now, there are some sectors of the economy that are doing well that will absorb space. And I'll just mention a couple of them. One is related to anything manufacturing oriented. So one of the other broader dynamics at work post-pandemic, and also given the very significant tensions between the US and China that I don't see changing anytime soon. I mean, if there's one thing Democrats and Republicans can agree on is they don't like China. So that's going to continue. We are going to see, and because of changes in policy as a result, we are going to see continued onshoring and nearshoring to the US. Supply chains are coming in, and that means a lot of manufacturing distribution activity is coming in to the United States, and that'll continue for the foreseeable future. You can see it in manufacturing construction. I mean, if you look at overall construction put in place over the last year is about $100 billion. I think manufacturing is already 150, 175 billion and going straight north, and for good reason. So that's one area where we can expect a lot of continued activity. Life sciences goes to healthcare and demographic demand. Data centers goes to obviously the cloud and AI. Those would be the areas where I would, Suzanne, expect to see the most significant absorption.
Thank you. And Rebecca, among the major commercial food groups, as a result, are you seeing any particular niches that are offering special opportunity right now? Whether it's
I think to build on some of Sarah's and Mark's comments, first, I would not underappreciate that, for example, retail, we've kind of called it one of the best kept secrets because, again, not everything is a BC mall with legacy, issues. And if it's grocery anchored, especially, there is a tremendous appetite out there. We're right now taking a portfolio of products to the market, and even CMBS is all over this thing, very interested and aggressive. So I think there are some pockets in the main food groups. To Mark's comments, life sciences, definitely a growth area. I think in the next 12 months, it's going to be more pharma driven, as we've seen other kinds of tenants pull back a little bit, with the interest rate environment, which has challenged tech and companies really reliant on VC funding. We have seen a bit more of a shift towards pharma being one of the key drivers there. That does dovetail a little bit with cold storage, very niche part of the industrial market, but one that is growing as online grocery as well as pharmaceuticals continue to gain momentum. Data centers, I think it's an interesting marketplace because there is quite a bit under construction, but finding the land to develop is a challenge. And as we go through this transformation with things like generative AI, you're going to need higher density facilities and lower latency capabilities to be able to actually provide those services to commercial customers if you are one of the big AI companies. And so I think that's going to be interesting to watch evolve, and something to kind of watch for there is the ability of utilities to keep up. That's been a challenge. I'm in Northern Virginia. There's a pause on development until Dominion can actually ensure that they can provide the power to actually generate the power at these data centers. So that's something to watch. The built to rent environment, as well as the single family rentals more generally. We cannot understate the impact of the current single family market on kind of funneling, especially aging millennials, into that property type. The normal spread for buying versus renting is about $80. If you were kind of going back over time and looking, right now the difference is $550 per month more expensive. So that wild swing has just pushed a bit, on the margin, demand towards not only multifamily living, but for these aging cohorts of millennials into that product. We also are seeing a lot of interest in other multifamily niche categories. So you can kind of say anything with a bed, basically, right? Senior housing, we're going to have the 75 plus age population grow by over 50% by 2035. Once they move in, they tend to be sticky customers. They don't tend to move out. And then on the student housing side, especially tier one markets with state schools or other large schools that have, other draws to them, perhaps major sports teams, they are underserved on the housing basis. And so we are seeing a tremendous amount of interest in that space as well. There are many others, but those are perhaps some of the ones that I've been hearing about the most lately.
And I would like to talk some more about retail, and we do have a retail specialist on the panel. Jody, if you could talk about changes you're seeing in retail overall, as well as in specific subcategories and what's really standing out. And I'd love for you also to talk geographically about where you see growth, where you see potential areas you're watching.
Sure. I would agree with Rebecca wholeheartedly. What we're seeing right now is in retail, grocery anchored is definitely leading in retail. I think one of the biggest things to note is the scarcity right now in retail and the scarcity of really well-located retail. Overall, we heard the stat just recently that overall over the last 15 years, the GLA in the retail sector has only increased 2.6% over 15 years. So there's been almost no growth and availability in retail. And you continue to have a spread, let's just say, between the well-located, in close. You heard Mark talk about convenience, maybe Sarah talk about the convenience, but really when you survey customers and they say, if you want something on demand, the store to 80% of the consumer is still the fastest way to have access. So really well-located grocery anchor continues to be of high demand. And as we're seeing, somebody talked about e-commerce and grocer. Most of that is being fulfilled by what we refer to as BOPIS, so buy online and actually pick up in store. That's still the huge percentage of what we're seeing. So I will continue to say what we've seen is the grocery anchored is strong, continuing to be strong. There is continued to be a huge bid-ask spread right now. So you haven't seen a lot of trades that have happened during this time. So I say scarcity. When you talk about the retailer, there's no question what we're seeing right now from the consumer is a trade from durables that we saw spike during the pandemic and just right post-pandemic back to services. So you're seeing a shift in the spending, but you're still seeing elevated spending. And we're still seeing last year, we saw sales throughout our portfolio. Retail sales increased close to 9.2%. So still, and a stickiness in that increase in sales. So what does that mean for us? It means right now too, as we're thinking about leasing, we're thinking about as we look forward, there is absolutely a scarcity. It is more expensive than ever when you think about capital costs, you think about labor costs. So I don't think we're seeing profit and EBITDA growth with our retail partners at the same pace as sales growth, but we're still seeing tremendous sales volumes that are happening. Geographically, I think for us and probably for most people, we're watching all of the markets that have low tax, high quality of life markets are continuing up post-COVID to be the winners. We're watching that right now as people are being called back to the office. How sticky is that change? I will tell you, we're not seeing any fall off in those markets. So I think quality of life continues to be as important though as cost of living. And it is both a real tie. So we're watching those markets really closely right now and what we're doing.
Okay. You know, I also wanted to ask you regarding, while we're on the subject of shopping centers, how are they evolving? Are we going to continue to see a focus on traditional anchors like a Macy's or a Nordstrom, or is it, I know we've talked over the past few years about some other types of users coming in. Is there going to be a big change in what anchors certainly a mall, other shopping centers as well?
Sure, you're seeing, I mean, I'll talk more open air than I'll talk mall, but you're clearly seeing the department store being redefined right now and how they are anchoring and what's coming in. But when we think about open air for us, the way we think about it, the grocer remains extremely important as the anchor. We think about everything in trips and dwell time, because if for every 1% of additional time somebody spends at our places, that translates to about 1.3% of additional wallet share. And that grocer is still driving somewhere between 1.8 and 2.2 trips per week. So that's an important part of how a consumer community member thinks about their shopping patterns. But in addition to that, what we're finding is an additional important anchor. You can use your traditionals of the pharmacy. F&B has come back strong post-COVID. So food remains a huge part of trip generating, but also the common area. And what is the place? People coming back, going into COVID, community was important, but post-COVID, how your place making is important, and not if it's over designed, but really, are there places where if you bump into your neighbor, are there places where I can bring my kids, I can spend time with and amongst my community? When we look at our trips and we look at our dwell time and our heat maps, our small gathering places or green spaces are vitally important to driving trips and dwell time. So I would say we look at those almost like we look at anchors, and how much trips are they generating, and are those trips cross shopping? Is somebody coming, are they spending time in a park, are they spending time in the common areas, and then also spending time in F&B, spending time with our retailers? So I think you're seeing that shift. You're definitely seeing a food shift that remains important. But those traditional anchors for us, like the grocer and the junior boxes, are equally important.
Let's talk for a couple minutes about office and then talk more broadly again about investment while we're in the individual property types. And Sarah, I'd love to get your input on I guess the big question out there, well, there's two big questions, right? How much distress do you expect in the office market, and what do you do with the excess space? Two big questions. So let's start with what happens with the office owners in their space.
Look, I spent a lot of time in my career on office. I'm still a believer in office, but even from my perspective, we're in a very challenging market. You know, when you looked at the burst of the dot-com bubble, when you looked at the GFC, well, you had spikes in vacancy at that point in time. There was an underlying sense that, okay, the economy will recover, people will come back to the office and we'll move forward. Now you have the hangover from COVID and what's going on with remote work. How is hybrid going to affect us long-term? So it's just created more uncertainty. On top of that, you have this real bifurcation in the office market. So the newer trophy buildings, you know, if one Vanderbilt in New York had another 5 floors, it would probably lease in about a week. You know, that product is doing extremely well and getting rents that, you know, have never been seen in the market before. Then you have commodity A and B product and below, and that is having, you know, rising vacancy, very difficult to lease. You know, one of the things that is also happened is, you know, the newer product was really thoughtfully designed around, you know, bringing more light and air into the building. You know, how do you utilize green space? How do you create a more dynamic office environment? And older product has tried to keep up with the amenity arms race that we've had. You know, they've put in gyms, but sometimes those gyms are in the basement of a building. You know, if you can work out in the basement of a building, or you can, you know, work out in basically kind of an Equinox type setting, people would rather work out in the Equinox type setting. And so you again have this shift really to that newer product. Now, you know, if you could raise, you know, wave a magic wand and, you know, just consolidate all the tenants into some buildings and have winners and losers, you know, you'd sort through it. The problem is we all have a lot of buildings that are, you know, 20 to 30% vacant right now. And we're having to manage through that. And so I think, you know, one of the things that we have to do is figure out how to partner with our tenants in the sense of how do we deliver a product that helps them excite their workers to come back. You know, if your work experience isn't commute worthy, then why would you commute? And so one of the things that we spend a lot of time on is how do we create, this goes back to Jody's comment about placemaking. You know, how do you place make in your office building, partnering with your tenants to create an environment that they want to be in. And, you know, it's a lot right now of the nuts and bolts of asset management. This is really when asset managers get, you know, should get all the accolades. You know, they have to sit there and figure out how do we drive leasing? How do we keep our expenses done, you know, within market ranges? How do we think ahead to what's going on with our debt, sitting on our assets and manage through that? But, you know, there's a lot of distress in the market, and, you know, it is going to be a rocky 12, 24 months.
Mark Gibson, what's your view? And maybe we it could talk
Please
office
tell me I'm
specific
wrong.
or overall.
I think Sarah's largely correct. Our view is we're just listening to the CEOs of the world's largest occupiers and a couple of macro comments. One, the US is an anomaly versus Europe and Asia relative back to work. So that's number one. Number two is labor productivity is falling dramatically across the US, pretty much across every industry. And you're beginning to see the work from work mantra appear. Doesn't mean we're not going to have flex. We had flex pre-pandemic. So it doesn't mean that you won't have certain occupancies and certain days and certain buildings. But if you go back and look at occupancy pre-pandemic, you know, on a Friday, or in some cases, you know, various components because of travel and others, that is the appropriate metric. So everyone needs to rebalance a little bit there. But work from work is going to be the narrative, and that narrative is going to be very much increasing over the next 12 months. The valuation side of office is different. So to Sarah's point, the top 15% of the inventory is doing incredibly well. The next 35% or so are down 20 to 50%, depending upon where you are and what it is. And the remainder, we just don't know. Some of these functional obsolescent assets it's yet to be determined. One thing I do want to say, which is wrong in the media, is the younger generation actually is very social, wants to be trained, wants to be mentored, wants to learn, wants the collaboration. And if we didn't allow our people back in the office, they would leave. So it is a very different story on the ground than it is in other venues that you may be absorbing data. So we think ultimately it'll be 12 to 15% less demand in office for a host of reasons, most of which are just common sense. And then the question is, where are those have and have nots? And to Sarah's point, office is probably the largest property type where you will have winners and you will have losers. It's a very large divide. I can't really discuss office as office because you have three segmentations of the office market, and they're all very, very different relative to demand.
So, given all of these issues that we've been talking about and opportunities as well, what's the anticipation for the investment market? Sarah, maybe you could comment on that. Investment overall is down more in the first quarter than it was in the fourth quarter. Do you expect that to continue? Do you expect anything to loosen up as we get further into the year?
Well, I think so. Part of what you see is still the overhang of the denominator effect on a lot of institutional investors, right? And so until valuations come down a little, which will address part of their denominator effect, you know, you see a lot of them staying on the sidelines. You also see the lack of transparency in pricing. So people just aren't sure where things are going to transact. And so I'm sure Mark probably could tell you that he is probably doing more BOVs today than at any other quarter he's ever done them. Everybody is calling brokers to say, hey, how much is this worth now? Could it trade? You know, trying to figure out what pockets could they raise liquidity so that they would have money available to them to invest in the opportunities that they see coming. You know, look, prices are down. The question is, you know, everybody is trying to figure out how much lower are they going to go and where do they see opportunities? And so I think it really comes down to looking at, you know, your sectors and your subsectors and really having your strong investment thesis and then looking for those opportunities that you see. And, you know, we have a lot of clients that are, you know, interested in deploying capital, but they're looking for things that are unique. And so part of what I think we're all struggling with is how do we identify what's unique right now? How do we source those? And how can we think about how are we going to deliver on returns that we're forecasting right now, considering all the choppiness in the market overall?
Suzanne, I'll comment on that too. I'll make a provocative statement. There's not a lack of liquidity. It's just you may not like the price of that liquidity, and you may not like the structure of it. So there's plenty there. And what we think is going to happen. So I'll go back to my argument where this is inflation driven. So whatever your view is on inflation, if you think it's going to be a runaway, you shouldn't invest. If you think it's under control and heading in the correct direction for Mark Zandi's slides, then you ought to think about that. Because if that is the case, the only reason we have elevated cost of capital is because we're fighting inflation. And at this moment, we don't have true oversupply. There's a few pockets of it in various aspects and various product types of oversupply, but generally speaking, relatively well balanced. Demand is reasonably good. There's not significant credit issues at this very moment. People think the Fed will overcorrect, and we will have those, but at the moment, it is not there. So if you believe inflation will moderate, and the 10-year bond is in that range-bound area, which historically, if you're 3 to 3.5, your cap rates are 4.5 to 6 for well-located good product. So if that's true, and the institutional mindset is there, and the private mindset is there, and you have a normalization of the curve because we are making progress on inflation. Let's just call it whatever your time frame is, 6 months, 12 months, whatever it may be. What should you be doing today? And what we're suggesting is when you look back 18 months from now, and if that plays out and inflation is moderated and the yield curve normalizes, it's pretty obvious you should be buying now. And if you have the intestinal fortitude for it, to everyone's comments here, particularly with the industrial commentary of inshoring, onshoring, friendshoring, whatever you want to call it, and multi-housing, I don't think there's any lack of consensus that we need more housing in the U.S. So if you believe that, none of this works, and the pipelines are down 70+% in terms of to-be-built product. So, the people that outperform benchmarks are those that think about these things 18 to 24 months ahead of them. Think about the probability of what has occurred. You've heard Mark give his view. I hope he's right. That's not what the market thinks in terms of recession. And so then start making policies, and we're beginning to see that happen. Because when you put this in perspective of why we're in the position we are, and you believe that we're making progress on it, it's pretty obvious. And so we're beginning to see that occur and things normalize, assuming, and this is the big assumption, which I hope we get, we have consistency and we don't have continued volatility, particularly in the bond market. That is very upsetting. The stock market is going to be volatile, but the bond market, it's unusual for it to be doing what it has been doing.
Okay, we just have a few more minutes, so let's turn to some audience questions, and we have had quite a few. We do have a question about trend shifts, whether there'll be a continued exodus as we saw during the pandemic from urban to more affordable suburban areas, as well as whether there'll be more company movements, whether it's based on that type of a trend or on state government politics, taxes, regulations, and so forth. And Mark Zandi, maybe that's a question for you.
Sure, and I apologize. I'm in a hotel room. My internet's going in and out, so if I freeze, then
we'll try.
you'll miss the meaning of life, but that's okay. Try again some other time. My view is that the outflow of people and business from large urban centers to suburbs, exurbs, and more rural areas will continue. And just to give you a sense of the numbers, and this is based on looking at credit file data. So I can see all the credit files in the country every month and get address and address changes. In the year ending in February of 2020, so right before the pandemic, 350,000 Americans net left urban cores for everywhere else. That was net. At the peak of the outflow, which was September of 2021, it was 700K on the nose, so the doubling. As of April of this year, it's down to 550,000 and it has stabilized. So it's kind of retraced half of the increase that occurred in the wake of the pandemic. And I think that's where we're going to land. That's where we're going to stay. And so I think that outflow, and that goes to cost, that goes to quality of life, that goes to remote work dynamics. That'll continue, going forward and become, a feature of the future landscape of America. So I think that, at least for the foreseeable future, until costs and prices adjust, and that could take a long time for that to occur. So I think that'll continue to be the case. And a lot of the migration, interestingly enough, I mean, New York is a good case study of the outflows of, and I should also say, as a point of interest, it varies a lot by market. San Francisco, the hemorrhaging continues. Philly, it continues. New York, less so. But one interesting result of the New York as a case study is that about a third of the people that are leaving the urban core go to the suburban ring. About a third go to the broader kind of Northeast region, and about another third go farther afield into places like Florida and the Southeast and Texas. So I think those regional demographic trends are now firmly in place and will continue going forward.
Okay. Another interesting question about is a person asking whether the reason the economy is still, is the reason the economy is still strong because people are still spending? And then a further observation that usually the economy is strong in an election year, which we would have next year. So what is your anticipation for what's happening, explanation for what's happening this year, and anticipation for how the election impacts next year?
Is that to me, Suzanne?
Sure. And if anybody else wants to join in, please do.
I've already said a lot. Rebecca, you want to dive in?
Sure. I mean, I think the first part of the question was around the consumer, and, that is definitely a factor contributing to resilience in the economy. And that's tied back to the resilience of the labor market, which across many measures remains sort of secularly tight. Consumers are 70% of GDP, so what they do matters. And, as they go, so will the broader economy. Not to say that there aren't a few pockets of concerns of things to watch for. For example, we know that income growth was now negative in the last few quarters. We know that savings is dwindling down, and while this is not as much the case for higher income consumers who do tend to do most of the spending, we are seeing an increasing sort of barbell effect, and that translates immediately into the kinds of retailers that continue to expand and property market leasing fundamentals. So very much, very important to the outlook. I think when it comes to elections, I sort of get concerned about saying just because an election year, we should expect strong growth. I think the economy is based on a lot more, and policy tends to lag in terms of its effects on the economy. We've done a lot of work every single election, whether it's a presidential election, a midterm, and I can tell you for real estate, they don't matter at all. Okay, there's literally no correlation. It is the economy, it is the Fed, and I would sort of draw a parallel to ice cream sales go up in the months of June, July, and August. It's not just because that's the case. It's because there's summer weather and people get hotter and they suddenly start buying ice cream. Cause and effect, election and economy, not there. So I would just draw some caution there. We're going to be watching the data. I'm kind of with Mark on the industry's expectations around recession, investors' expectations around recession. If it does start later this year, the average recession is about 11 months. So that would put us second half of next year entering a growth cycle. And that's when we are calling for a growth cycle to pick up in full. So hopefully that helps a little bit, but I certainly caution against the whole election tea leaf reading.
Good thought. One last question. We do have one, Mark Gibson, for you. If you think the Fed will delay lowering interest rates in response to lower inflation and thus drive the economy into recession, why would an investor buy property now?
Well, first of all, it wasn't my opinion. I was just telling you what the largest owners of capital and those that manage money for them are thinking. Because ultimately, the bond market will pre-run or front-run the Fed's actions. And again, just to be very specific, just to give everyone a little comfort that maybe haven't been through some of these cycles, what's happening now is pretty normal. People are looking at the Fed's history over time. They're very, very smart people. It's just they have data that lags. And hopefully they're getting ahead of this a little bit. So the investor market knows that. The statistics are quite clear. So they know that. And they understand how the public market moves versus some other actions that take place, namely the Fed doing something different. Again, their data lags what is really happening in the marketplace. So that is the rationale behind it. And when I say people are acting normally, I think the last 3 years have been abnormal compared to the previous 30 years in terms of investor behavior and lender behavior and various other components. And now, today, people are appropriately looking at risk. They're underwriting debt. Again, plenty of equity and plenty of debt. The question is what are price and structure. So they're doing it and investing and or lending with a recession-oriented risk component to it, which is what they should be doing at present. So this is not unusual, I would say, relative to what we've experienced, particularly since last July in the marketplace with the fight against inflation and rapidly changing cost of capital.
Thank you for that insight, Mark. That's very helpful. Unfortunately, we are out of time. We do have a lot more questions. I wish we could get to them, but thank you all for attending today. We will be sending you a link when the recording is available, and we hope that you'll join us for our next CPE webinar. We've got one coming up in a couple of weeks. We also hope you'll be able to join us for our year-end outlook through our CPE Voices toward the end of the year. So watch out for information on that. We also have more focused multifamily discussions offered through Multi-Housing News, including these types of discussions. So we welcome you to register for those as well. Meanwhile, I would like to thank our speakers once again for this very interesting discussion, and thank you all for joining us today.
Thank you.
Thanks.